Yeah, thank you for having me. So I feel like I'm kind of the odd one out, someone from non-academia, from industry, so I thought I'll spend one slide on what we do and who we are at Winton. Winton is effectively a global investment management company, but it's fully driven by data analysis. And we mainly trade futures and stocks all around the globe. It's fully systematic, so we don't have really these tall and handsome and guys in suits making decisions into what to buy to gold and sell S&P and things like that. It's completely systematic. And as a consequence, data collection and processing and analysis of it is at the heart of the company. So as usual, it always starts for us is by collecting data. So we collect this massive amounts of historical data going for wheat prices, for microsecond order book level data. And then obviously we spend a lot of time trying to cleaning and organizing that data set, putting into databases, making sure that we get the right prices for the right assets. And that takes a lot of effort in our company. And finally, then you can get to a stage where you start thinking about ideas, what's driving the markets, and how we can start thinking about predicting where the markets are going to go. And as a consequence, we do a lot of testing and peer reviewing once we come up with any ideas, just like a normal in the publications world you would do. And finally, once we're happy that we found something, then we put that strategy into live, and that's executed fully automatic fashion as well. I just thought I wanted to give you guys an idea of what sorts of data we look at, because generally there might be some misconceptions into what type of data that financial data can be. Let's just start with this Apple prices, for instance. So say we're interested in predicting where Apple is going to go next week or next month. One thing you might be interested in thinking, oh, well, let me just look at what Apple has been doing historically. So you can pull out this data even from Yahoo Finance and say, oh, well, it looks like it's been going up recently, maybe it will continue to go up. So that would be one way of trying to predict where this thing is going. But there might be some other interesting data out there that might help you to predict this. So maybe you might think, I'm not saying this is the case, but you might think that maybe the company's balance sheet is relevant. Maybe when they recently declared that they made, I don't know, 17 billion in their earnings, maybe it's a relevant information in terms of where this company is going. You can also maybe say, oh, their tangible assets has decreased compared to last time they declared this balance sheet. So that you might think that's a relevant information. Well, you might also say, well, Apple obviously is selling tablets and iPhones all around the world. So they're selling, well, according to that, this data said 40% of their sales is coming from the United States or North America. But there's a good chunk coming from Europe and Asia. So you might think, oh, well, maybe where Apple is going in terms of their prices is relevant. It's important to know what's going on in Euro USD exchange rate, because if that goes really high, maybe Europeans are not going to be able to buy iPhones anymore because it's going to be really expensive for them, et cetera, et cetera. So you might think the FX rate is a relevant predictor for where the Apple prices are going. But you might also wonder that all that information was more directly relevant to Apple, but there might be also some other stuff going around Apple that's relevant to where the Apple prices are going. So here's a little example, for instance, a little customer supplier chain. This is within the information technology sector. You can see that, for instance, an arrow here indicates that that particular company is supplying something to that company on the other hand. For instance, you can see QLogic is supplying to HP, AMD is supplying to HP. So those are the companies that are supplying some services or some product to those companies. So you might say, well, if AMD is not able to sell any chips anymore, probably HP is not able to sell any more computers. So you might say, well, okay, clearly it's not just HP's prices is relevant. You might think about, well, what's going on in AMD's world is also relevant to predict what's going to happen for S&P in the long run, or for HP in the long run. So there's information not just particular to that particular stock, but there are other informations around that stock that might be relevant for predicting that stock. You might also say, well, the market share of Android has been increasing compared to recently. Well, that might indicate for the future that maybe Apple is not going to be able to sell enough iPhones, and that means that's going to have some impact on the future prices again. So there's lots of sources of information that might be relevant to predict stock prices. The other thing, well, maybe the global economy is interesting. So when the economy is contracting, maybe particular sectors like healthcare, staples, because you still have to buy bread and drink water. So maybe those companies are still going to do okay, but the companies who require a lot of capital, like IT or energies, maybe they're not going to do so well. So maybe where the global economy is where it's going is also relevant in order to predict what the stock price are going to do. This is an interesting one. This guy is a really successful investment manager, said once, to be successful in business and investing, you've got to have skin in the game and a stake in the company. So he's kind of saying, well, if you're in the board of Apple and you're starting to sell Apple shares, maybe that means something, that maybe you know something about to predict where the stock price are going to go. Or if you're starting to exercise your options of your own company, maybe that says something about what the company is going to, how the company is going to perform. So that sort of data could also be relevant to where the Apple is going. So putting all that together, our data sets generally looks in this shape or form. I put dates over there, but that's not necessarily restrictive. It could be date and a time. So I could be reporting data per millisecond, just for ease of explaining. For the moment, it's just days. But what you got is effectively a day and lots of prices corresponding to lots of stocks, because as we discussed, maybe the history of Apple is somewhat relevant where the Apple is going to go in the future. But we also discussed that, well, Apple and Google are related in some shape or form because one is supplying to another one, so those prices could also be relevant to predict Apple. So we have effectively a matrix of data just from prices. But then we said, well, the balance sheet could be relevant. So the fact that Apple on the 20th of May disclosed that their revenue was 47 billion, maybe that's relevant information, so we'll bring that into the play. But in an asynchronous fashion, a couple of days ago, Google announced that they had 17 billion of earnings. So maybe there's some dynamics in there that we need to take into account. So we bring that data set in. But as we discussed, it could be that the FX rate is playing a role in how much Apple is able to sell iPhones or iPads. So we need to bring in all that information into play as well. So we need to bring in, on that day, what was the FX rate for all these global currencies. So that's relevant information. The other thing, the interesting thing we discussed is it is interesting that, for instance, on the 15th of May, Tim Cook is one of the top guys in Apple, decided to sell 10,000 shares of his own stock. So what does that mean about where the price is going? Maybe he knows something about short-term price moves. Similarly, maybe Larry Page, a couple of days after, decided to buy 25,000 shares. So these are all possibly relevant information that we have to bring in the table. The other example was where the global economy is going. Maybe that is helpful in terms of predicting particular stocks. You might have on a particular day, on the 17th of May, say a GDP announcement says now at 2.2%. A couple of days before then, you could have a CPI saying there's an increase of 0.1%. And then again, on 21st of May, you can have some sort of non-farm payroll announcement, which says 222,000. So that maybe is giving you a feel for where the economy is going. So that, and if we think that's relevant, that information, we should bring that on the table as well. So what I wanted to get across with those examples, I guess, is that the financial data is very non-stationary. So it's got properties that are not time variant, but it's also very heterogeneous. One data is in prices, the other one data is in percentages, the other data is number of shares, the other one is FX rates, it's completely different. So it's a very heterogeneous data set, and as you can see, it's multivariate. So for predicting one stock, we're interested in lots of sorts of areas of information. And by its nature, it's also asynchronous, because not all companies declare or report about their balance sheet on the same day or on the same time, so they report in a synchronous fashion, so you have to take that into account. The fact that Apple just declared something now, even though Apple hasn't declared anything, probably said, if Google declared some balance sheet now, but Apple hasn't so far, that probably says that you can infer something about what Apple's balance sheet might look like. So that asynchronicity is also interesting and important. It's also, financial data is contextual. Like a couple of days ago, there was a really funny example, I think. there was a GDP announcement. I can't remember now. I think it increased by 0.5% or something, and Bloomberg said, stock markets are up because GDP has increased by 0.5%. And then half an hour later, the stock market actually turned around completely. It was down 1%, and the Bloomberg news line is literally just changed from stock market up from due to increase in GDP, stock markets down due to GDP increase, because it meant that the GDP increase meant that there's a healthy economy, but it might imply that they might raise the interest rate so that if the borrowing might be more expensive, so they might have some effect. So I guess the message I'm trying to get across here is that just because GDP is up by 0.5% doesn't always have the same implication about what the prices are going to do. So the financial data is contextual. And as we've seen, there's a lot of it that we have to deal with. I think it's very similar to some of the problems that we've discussed. We don't have a lot we have a lot of variables, but we don't have a lot of time timestamp, if you like. Maybe unfortunate, maybe it's something unfortunate for us. We only have one history. I can't go and create another prices for Apple. So maybe one can go ahead and try to run more trials to understand if a drug is working. We kind of struggle with that. We don't have I can't get someone to create another Apple stock and trade that on the side for me and just no one else to see it and only I get to see it. So we don't have that luxury either. So we have only one history. So once we get to use it, we get to use that data. That data is consumed. So we have to be very careful before we start consuming data. And no data is clean, obviously. Everyone knows that. But in our cases, I find, and it's probably similar in lots of other cases, even the clean data is full of tricks and traps in our case. So one thing that we tend to come across, for instance, say that number 47 billion of Apple's earnings announcement, the vendors or the data, the people who are collecting that kind of data say to you, on the 27th of February, that was the number, 47 billion. And you go ahead and do analysis and you do a lot of work on that, or you find that, that's interesting, maybe this earnings actually is predictive, but then you end up learning that that number has been changed retrospectively. So original number was, say, 30 billion or whatever, and then 2 months down the line, actually they corrected. The correct number was 47 billion, but they still assigned it to the historical date. So you sort of had some sort of future information in your data, even though it was clean. It was the right number. Their earnings was 47 billion, but actually you wouldn't have known that number at the time that it was actually announced. You'd only know that 2 months down the line after they corrected and found the right number. But the markets tend to be clever enough that incorporate that information very, very quickly. Another major problem for us, I think this is probably more unique to us, is that the historical data has our footprint in it. Because we do trade, even as we speak, Winton is trading, but the prices we collect has this impact in it. Obviously, the current price of Apple wouldn't have been what it is if we were not in the market. Because we want to buy, as Winton, we go into market and we say we want 1,000 shares of Apple, that has an impact on the price. And that, as soon as that has impact on the price, then the price you're collecting, in historical price, is effectively something you have something to do with. You can't treat it as, oh, this is a completely a set of data where I can pretend that this is brand new data. It's not. You already had something to do with that data. It's correlated to your actions to some degree already, if you like. So there's all sorts of tricky biases that's in there that we can probably talk hours. So effectively, our challenge can't sort of be summarized in this one slide, given if you can digest everything we've already seen, is that we're interested in predicting stock return for tomorrow, next week, or next month, using all the information available to us, knowing that actually we don't know what information is relevant to us. We can hypothesize, like we discussed a second ago, half an hour ago, should we just let the machine learning algorithm go wild and find that the fact that Apple had up, down, up, down, up, down means something, or should we just hypothesize that if it goes up, up, and then it should go up the next day? It's a tricky question, but what we're interested in generally, given all this information that we're aware of and we think might be relevant, condition on all of that, we're interested in finding a conditional density in effect. and we ideally would like that to be sparse because we want some sort of control for overfitting and all that problems that comes with having lots of parameters. We'd like it to be smooth because we don't want our predictions to be very jittery, change over time. And again, touching on some of the stuff we discussed, we'd really like it if it was interpretable. Because it's really hard to explain to a client, well, give me 10 billion, I'll just pass it through this black box and it tells me to buy some apple and sell some gold, and trust me, it's going to work. That's a hard sell. So it needs to be somewhat interpretable. It needs to have some understanding behind that, why this idea and why this methodology might work, and it needs to have some sound fundamentals behind it, at least. I mean, absolutely, we do things like we do let machine learning algorithms go wild and try to see if they can find something that we couldn't hypothesize, just like touching up on some of the stuff we discussed. But on top of that, suppose there is something that actually we're convinced enough, what we end up doing a lot of the time is trying to pick it apart, and we spend a lot of time trying to decompose into things that we actually can understand. And we would, in majority of the cases, we would be happy to give up a lot of performance for a trade-off of interpretability and understanding is actually what's going on. So it's a very complicated and tough challenge for us. But it's complicated, but it's not like it's not doable. Here's a little example that I cooked earlier. I like that when the cook brings from behind the already perfectly done up pasta in the background. So this is one of those. So this is one of those F functions that we come up with after many years of research, which actually does take into account these tons of asynchronous, non-stationary, heterogeneous time series in order to predict thousands of stocks. So this is from one of the analyses. I mean, I cannot talk about what their function is, but I can maybe tell you about how it seems to be performing. So if you look at that, how it's been performing in the last, say, 15 years, and what I'm plotting there is the cross-sectional correlation between what I think those 1,000 stocks are going to do and what really happened in reality. And you can see that some days I'm 10% there, some days we're off 30%, and it just looks like a really wild ride, and it's something that you wouldn't be able to tolerate. And if you put all the data together and looked at, well, how it's on aggregate on the 15 years it's been working, generally speaking, we go far back, but just for presentation purposes, you see that, well, my prediction quality, it looks like it's only of 1.5%. And you might be like, oh, look at this guy, he's got 1.5% prediction and he's giving me a lecture. But it's actually in finance, 1.5% can be interesting because there's not that much predictability in financial prices already anyway. So you can take that 1.5% and possibly, actually one of my managers said, make sure you put possibly in there because we're never sure. Possibly we can turn that 1.5% prediction quality into profitable investment strategy for our clients. And this is one of the examples. That's 1.5%, which one might diss, but it's actually great in finance. Can look like this in outer sample in real world. I mean, even in finance, I also find it's a bit of a test to your character and emotional stability as well. Because like we put this system live, I think it's Jan 2013. And I was feeling pretty smug about it in October 2013. I was pretty proud, look at me, because this is a zero-sum game, and there's a lot of other clever people trying to do something better or just competing with us. So if I'm making money, someone else must be losing. So I was feeling good in October, and there comes the August 2014, where we started a year and a half ago, and questioning my soul, my education. Should I have gone to Harvard instead of Cornell? And maybe UK was a better choice. But then you hang in there and you rely on your research. You hope that you've done everything you can do and stick in there. And then the markets tell you, well, you have something, maybe. If you're hanging in there, you might be able to realize that 1.5%. And that is a great success story if it happens to be the case, because it's very hard to extract money from the markets. But that doesn't even end there, unfortunately. To trade an investment strategy, like, for instance, the one we've just seen, it's not enough. It's just a starting point to have a good return, good prediction model. So somehow, from return predictions, we have to go to positions. So we have to say, well, what do I want to do today about Apple? I don't want to sell this much, that much. And actually, we could go ahead and do that execution ourselves as well within Winton. And that's also just as a challenging problem. What happens in the markets is like an auctioning process where the red is effectively the lowest sell price and green is the highest buy price. And all the other things going on around it, the white levels and the shades, is how many, the number of orders sitting and waiting there to be executed. So if the price goes up to that level, you get your order filled. If it doesn't, you don't get filled. So obviously, because if you want to realize your return model, you need to achieve the position you want to get into. So that poses another decision-making problem. So let's just say we're in that where this is an intraday. Say there's like a minute worth of data, and in a minute you can get millions of prices, millions of updates. So we're in that dashed line moment in time, and we need to now decide how we're going to sell 100 shares of this Apple. If you put your sell orders too high, well, I want to sell my shares really high because you want to get high price for them. You might miss the market. Market might go away from you. If you put them too close, then you sold them too cheap. That's not great. And if you put them somewhere in between, then because it's a FIFO process, you might or you might not get the trade, depending on if the market hits your order. So this poses a great challenge, very complicated and great challenge again. How many orders at what distance away from the current ask price should we place our sell orders? This needs to take into account the participants in the market. How would they react if they were to see your order? What's going on in the other assets? Is there a recent announcement going on in the market? Again, there's a lot of variables going into this complicated modeling. And that kind of brings it to the end for me. I discussed a little bit about return prediction and execution algorithms in this talk, and just a few of the many challenging tasks we have at Winton, and it's an ongoing challenge. We don't have a ground truth, so we don't know how the markets work like. So the challenge of taking into account the non-stationarity or the contextual analysis, it's an ongoing challenge, and it's going to be an ongoing process for us. We're always interested in finding new data sources and what might be relevant to predicting stock returns. I discussed a few, like FX rates, or if Tim Cook has just sold some shares of Apple or whatever. There might almost be some other data sets out there that might be relevant. In addition to return and execution, we're very interested in predicting risk. We want to know the uncertainty of our predictions. I might say, well, Apple is going to go up 0.5%, but it would be nice if someone can tell me if that's guaranteed to be. Is it like a plus 0.3 and plus 0.7, or is it actually like -2 plus 5%? Obviously, your reaction and your decision about that will be very different. So we're interested in predicting variance of the assets, correlation across assets, concentration of our portfolio. In an ideal world, we'd like a lot of return for not risking anything. So that's a challenge. And also, portfolio construction is a very complicated challenge as well. It's given that we now have this return and risk predictions, and this is the way we're going to execute these trades. What positions should we be taking tomorrow? That is a little bit of a control problem, and because you need to do multi-period planning, but also you have to take into account your return horizon and how you're going to execute it, how much it's going to cost. So that problem usually tends to look like a constraint optimization problem, if you like. And this just says everything I said is a lie.